Alright everyone, welcome to my channel. This video I might post it on YouTube because I'm only reviewing the trades I take and aka the trades and didn't take but I would have took but I was asleep but I saw it and I know that I was gonna take it but my alarm didn't work today. I don't know why. Um but that would be a nice risk to reward here on a nice confirmed trade. So we started out by marking the highs and the lows of Asia and London session. That's what we did. And on the 5 minutes, okay, the 15, we can see like that price swept the liquidity of the previous sessions here. And I saw that first sweep here, but that wasn't a real like I didn't wait for a reversal from this level because we can see that there's no inverse formation like fair value gap. There's no imbalance formed here. So I waited. I didn't wait, but I would have waited because I know that today we would have go for shorts because that price was up here going up. So I'd expected it to go reach those highs. I'm sorry for the noise. And come back down here. So that's what I found. I was searching for that and I found it because because that was my bias, right? So when price steps back here and goes above the liquidity pool at the buy side liquidity, we can see that price formed a fair value gap. I'm gonna I'm gonna stretch this out and put on my magnet so it's more accurate. Over here, we can see that price formed a little inverse over here and a fair value gap. It didn't got retested, but for me, honestly, I that's like when price swipes liquidity, right? It's more than enough for me. Like there's levels here, and then price comes up here and does like that and forms. Yeah, the drawing is really fucking bad, but you can see that I formed an inverse and a fair value gap. Uh, unicorn model. It didn't unicorn model because, but it didn't tap back, you know. But the unicorn model is basically when price forms an inverse fair value gap and a fair value gap and a fair value gap on the same sweep, you know, on the same move because now we see that it go high to reach those highs, right? And then it goes back like that. A big bearish candle. So I would have entered here. I know myself. And if not, if I lost this trade, at least I know that price didn't want to go in this direction. Or catch off guard, catch off guard, and fill out some orders that was still up there, you know. But it reached higher, go down with a formation of inverse fair value gap, inverse fair value gap, and a fair value gap at the same time. And I would have entered short here, targeting all these previous 5 minutes liquidity. As we can see, is a little pool of liquidity here, like over here, that level here. You can see that there's orders to be filled over here, but to be safe, I would have put my stop loss over here, above above the wick, means at the body, at the bottom of the body of this bullish candle. I'm sorry, I just have trouble with a drawing tool because I know that every time I wanna move my chart and all, and I end up drawing on it. Some of you will relate to that, I'm sure. But we end up winning this beautiful trade with I'll calculate right now my how much I would have won. You mean that 100? No, no need. $240 risk on my funded account, on my trade of it funded account. Um, for a 400 win, $400 win. That's how it works, right? You do the risk plus the amount of the trades it takes, right? And that's how you calculate it. Unfortunately, I couldn't take this trade, but I consider it as a W. But it's unfortunate. It's okay. At least I know that my model works well, and I'm sure that a lot of you out there like use this model a lot because it's really like it's very common, you know, just to look for liquidity because price hunts liquidity and fill out the imbalances, right? That's all the market does. So that's what happened here. We got a big gap. I think it's a weekend gap. Monday. No, it's not actually. It's the end of the New York session gap. It's really weird. Yep. The big gap. I wonder what happened. Could have seen the news. So, but today we had FOMC at 2 p.m. We still have FOMC at 2 p.m. and we're gonna see the interest rates change depending on what he's gonna say. As you can see here, the rate decision is usually priced into the market, which is focused on the future. So it will have a lot of impact on the market. That's why it's a red folder in the first place. So yep. So that's pretty much it. Thank you for watching the video.